Are you ready to navigate the twists and turns of the housing market in 2025? Today, we're going to talk about three crucial topics that will significantly impact homeowners and prospective buyers alike. First, we'll update you on the latest housing market trends. Next, we dive into mortgage interest rate predictions for 2025. And third, we'll explore what these changes could mean for home prices. By understanding these elements, you'll be well equipped to make informed decisions that could save you money and stress in the upcoming year. Let's unpack these topics and discover how they can help you in 2025. Housing market updates. As we approach the threshold of 2025, gaining a clear understanding of the housing market's dynamics is more important than ever. The real estate sector has been experiencing a significant surge, with fluctuations in mortgage interest rates heavily influencing home prices. For instance, this past November, we observed a notable increase of 5.4% in median home prices compared to the same period last year. Such data, sourced from MLS and public records, highlights a market that is not just active, but positively vibrant. Let's delve deeper into these trends to grasp what's really happening beneath the surface and what it means for potential home buyers and sellers as we move closer to 2025. The rise in home prices is not just a number, it's a reflection of multiple underlying factors that are shaping the market today. This surge is primarily driven by a decrease in mortgage interest rates, which historically boosts buying activity as more people find it financially feasible to purchase homes. The increased demand, coupled with a finite supply of homes, pushes prices upward, creating a seller's market where bidding wars become the norm rather than the exception. In the context of the current market, the statistics from sources like Redfin and the National Association of Realtors provide a broad picture. According to their reports, home prices have risen by an astonishing 45% since the onset of the pandemic. This kind of growth is unprecedented and has significant implications for the market's future. Charts and trends from these organizations show a sharp climb, followed by what appears to be a plateau. If you're wondering whether prices have started to crash again, the current data suggests stability rather than a downturn, but with cautious indicators of volatility that could suggest changes as we head into 2025. Mortgage rates are a pivotal factor in this equation. As rates fall, as they have in recent months, we typically see an uptick in home buying activity. This is because lower rates decrease the cost of borrowing, making mortgages more affordable for a larger pool of buyers. However, with the Federal Reserve's recent indications of a more conservative approach to rate cuts, there's uncertainty about whether these lower mortgage rates will sustain. If rates begin to climb again, we could see a cooling off in the market demand, which might stabilize or even reduce home prices. Looking at historical data and future predictions, it's clear that the market is in a delicate balance. Financial institutions and market analysts project modest growth in home prices, ranging from 1% to 3% into 2025. This growth rate is considerably tamer compared to the spikes observed during the pandemic, suggesting a return to more traditional market conditions. However, the exact trajectory will heavily depend on broader economic factors, including inflation rates and the overall economic recovery post-pandemic. For prospective buyers, this market condition signifies both challenges and opportunities. On one hand, the competitive market means that good deals on homes might require quick and assertive offers, possibly even above the asking price. Current statistics show that about 1 in 4 homes are selling above list price, which underscores the need for buyers to enter the market well prepared and possibly expect to pay a premium for desirable properties. On the other hand, for sellers, the market presents a favorable environment to get maximum value for their properties. However, they must also navigate the timing of their sales carefully, as the potential for increasing mortgage rates could cool buyer enthusiasm down the line. Understanding the nuances of the housing market as we approach 2025 is crucial for making informed real estate decisions. Whether you're looking to buy your first home, invest in properties, or considering selling, keeping a close eye on market trends and mortgage rates will provide you with a strategic advantage. Stay tuned to our channel for ongoing updates and expert insights that will help you navigate the complexities of the real estate market effectively. Subscribe and join our community to ensure you don't miss out on any critical updates as we track the ever-evolving landscape of the housing market into 2025 and beyond. Mortgage interest rate predictions for 2025. Understanding mortgage interest rates is essential for anyone looking to buy a home, refinance, or simply gauge the economic climate. As we look towards 2025, predicting the movement of these rates becomes not just a matter of financial planning, but also a strategic necessity. Let's dive into what shapes these rates and what we can expect in the near future. Firstly, it's crucial to clarify that while the Federal Reserve does not directly set mortgage rates, its policies profoundly influence them. The Fed manages monetary policy through mechanisms such as setting the federal funds rate and conducting open market operations, which in turn affect the bond market. The bond market's yields, particularly those on U.S. Treasury securities, are a benchmark for setting mortgage rates. When the Fed adjusts its policies, especially in response to economic indicators like inflation, it sends ripples through the financial markets, altering the cost of borrowing, including mortgage rates. Recently, we've observed 30-year fixed mortgage rates approaching the 7% mark. This uptick is a response to a complex mix of economic factors, including inflationary pressures. The Federal Reserve's cautious stance on interest rate cuts stems from an uncertain economic environment, where controlling inflation without hampering growth is a delicate balance. Looking ahead to the first quarter of 2025, forecasts suggest that mortgage rates will likely settle in the range of 5.75% to 6.25%. This prediction considers several factors. Inflation expectations. Inflation erodes the purchasing power of money, prompting lenders to demand higher interest rates as compensation for the decreased value of future payments. If inflation expectations remain high, rates could lean towards the upper end of the predicted range. Economic growth. Stronger economic growth tends to lead to higher mortgage rates. If the economy performs better than expected, supported by consumer spending and business investment, this could exert upward pressure on rates. Federal Reserve policies. The Fed's future actions will heavily influence rate trajectories. Current indications suggest a conservative approach to lowering rates, aligning with a strategy to manage inflation cautiously. This conservatism is likely to keep rates from skyrocketing, but won't necessarily push them significantly lower quickly. Analyzing the bond market's influence. The bond market is often a predictive indicator of mortgage rates. Generally, a rise in 10-year Treasury yields leads to an increase in mortgage rates, and vice versa. The relationship between these can typically see mortgage rates running 1% to 2.5% higher than the yields on 10-year notes. This margin accounts for the additional risks and duration premium associated with mortgage lending compared to government securities. Analyzing the rate trends. Navigating the intricacies of mortgage interest rates involves understanding their connection to broader economic indicators, particularly government debt interest rates, such as the 10-year Treasury notes. This relationship is crucial for predicting future mortgage rates and making informed decisions in the real estate market. Historically, mortgage rates tend to be 1% to 2.5% higher than the yields on 10-year Treasury notes. This premium accounts for the increased risk and longer duration of mortgage loans compared to government securities. Currently, with the 10-year Treasury note hovering around 4.5%, we can extrapolate that mortgage rates might align within the projected range of 5.75% to 6.25% by early 2025. Why does this spread exist? Lenders need to compensate for the risks associated with lending money over longer periods. Mortgages, typically extending over decades, expose lenders to various risks, including inflation fluctuations, changes in economic conditions, and the borrower's long-term financial stability. By charging a higher rate than Treasury notes, lenders mitigate these risks. Moreover, this spread reflects the market's anticipation of future economic activities. Factors like inflation expectations and Federal Reserve policies influence both Treasury yields and mortgage rates, albeit in slightly different magnitudes. As the economy shows signs of growth or concern, both rates adjust, but mortgage rates consistently maintain a higher level to account for the added risks. For potential homeowners or investors, keeping an eye on this relationship can provide insights into when might be a better time to lock in mortgage rates. If the gap between the Treasury yield and mortgage rates widens significantly, it could indicate a good opportunity to secure a mortgage before rates climb higher. Conversely, a narrowing gap might suggest waiting a bit longer could be beneficial. By understanding these trends and their underlying causes, you can better navigate the complexities of buying a home or refinancing in a fluctuating economic environment. As we approach 2025, staying informed and proactive in response to these trends will be key to securing favorable mortgage terms. Here's some practical tips for home buyers and sellers. For those looking to buy, the advice is clear. If you find a reasonably priced home, consider offering above the list price. Approximately 1 in every 4 homes currently sells above the asking price, reflecting competitive market conditions. However, always balance this with the goal of not overpaying in a market poised for only modest gains. As we look towards 2025, staying informed and adaptable is key. Whether you're planning to buy, sell, or refinance, understanding these trends will help you make better financial decisions. The exact trajectory of mortgage rates will depend on broader economic policies and market responses, but by mid-2025, expect clearer indicators to guide your real estate strategies. Keep this channel bookmarked for continuous updates on mortgage rates and home prices. Our goal is to provide you with accurate forecasts to help plan your next steps in the housing market. Subscribe for more insights, and thank you for tuning in to our detailed analysis of what to expect in 2025. Let's navigate these changes together, ensuring you're prepared to make the most informed decisions in the evolving real estate landscape.